next video is actually on IFRS 16. These are leases, by the way. That's what this standard actually looks at. So we want to first get an understanding on leases, the types of leases that are there as well, and the like. So a lease is it's like a certain rental, payment that we get to pay on a certain asset that we have acquired from maybe another firm and the like, that we are going to use for a certain period of time. So there's two types of leases. We have an operating lease and a finance lease. So these two just have to be understood, even as we'll be getting into the standard and how we treat leases and the like. So an operating lease is one that's like it's like held within like 12 months or so. And then a financial lease or a finance lease is one that is for more than 12 months. More than 12 months. So basically that's your two types of leases that you need to know. And most of the time when we're looking at leases, we want to get to see how the accounting treatment is for leases, how we can be able to identify those non-current liability of a period, and then also the current as well for the period. Because mind you, a lease is like, it's something that you've sort of like you're renting out, so there'll be some owings or some payments that will be due. Yeah, so those same payments that are due on something will make it a liability of some sort, because there'll be some obligation to pay, due to some, of course, borrowings due to these rentals. So let us now look at how the treatment is for leases. So, well, when you'll be given a lease, and of course there'll be the lessor, who is the person giving you what? The lease, the person giving the lease, right? And then there's the lessee, the one that holds on to the lease and uses it, if anything. That's the lessee. So most of the time we want to get to understand the treatment on how this person, the lessee, will be recording this lease. How does this person recognize the lease in these books of accounts? So, well, first of all, a lease, once obtained, can equally be identified as a non-current asset to this lessee, the one holding on to the lease. Why? Even though he's not the owner. Well, the rule that's actually there is that the fact that he's holding on to this particular item for some period of time, meaning control has been given to him, right? Somehow. That's just how it is. Control has been given to him, and any benefits that come from this particular lease are given to the particular lessee. So most of the time you'll be given leases for 4 years, 5 years, and that falls in which category? A financial lease. And if you look at a financial lease, these are leases that, more than 12 months, and such leases transfer all any risks involved and any benefits that might come from the lease to you who's holding on to it. And if you look at how IAS 16 defines an asset, it's something that you have control and other benefits as well. So that is why you get to categorize that lease as your non-current asset. That's the first thing. So most of the time you will be given as well, as I said, maybe a fixed payment that you'll be paying each and every year towards that lease to the owner. Of course, the original owner, yes, you'll be giving this person a fixed payment. You might also be given what they would call the fair value of this lease. Maybe it will be like a certain amount. It's a fair value. Most of the time what we get to do is that once you're given a fair value and you're also given those payments, right, for the period, what happens is that you get to first of all find the present value of these payments. You discount them to the present, just like some application of your time value of money knowledge. And then you get to just like discount it, and most of the time we get to pick the lower of the two between the fair value and the present value of those payments. That's what happens most of the time. And we will look at an example in this video that will actually clarify all these points and the like, and we'll get to understand all this. So let me just get to show you the formats that we'll use as we are getting to account for a lease in our books. So we would use what they would call an actuarial method, which is just like amortization, by the way, where you have your year, you have a balance, you get to have what? The payment itself, sorry, interest. Let me put interest. I'll just be abbreviating some things. Here we'll have what? The payment, that fixed payment that is fixed throughout the lifetime of the lease. And your balance brought down. Sorry, balance carried down. The first one should have been balance brought down, because it's like the starting there, and then carried down is like the closing balance, if you want. So this is the format we get to use when we are looking at a lease that we are trying to account for. Specifically, what lease? A lease paid in arrears. What do we mean? In arrears, it's like it's paid at the end of the year. Okay, so the it's in arrears, that's at the end of the year, and this is the format we follow. So you would have years. For example, your lease is 3 years. Let's just give a rough example. So if your lease is like 3 years, for example, right? What starts here in the opening balance there? As I told you, there is a fair value amount that is given, and you have also your payments that will be stated. So after you've obviously found your present value of your payments, and you're getting to see, okay, maybe the law of the two, this one you go with, as I said. That's the one which starts here. You start with it. That's the one which opens. The law of the two between the fair value and the present value of all those payments. Then how do you get interest? Interest will be stated in your question. To be stated, the interest is charged just on this same opening balance that we have, and we get to put a figure here. So it's just the format. As I said, it will make sense with an actual question when we solve. Yeah. After we charge the interest, we put a figure there. What goes in the payment column? I said there will be a fixed payment that will be stated in the question. That same payment that will be the payment towards the lease. The even say the payment over the life of this lease will be this. That's what we put here, and we put it in brackets because the payment is like subtracted off to be reducing the total lease payable, if anything. That's why we subtract the payments. We don't add it because it's reducing as the years go by. It's reducing your payments towards the lease. That's why we subtract it. And then you have your balance here. So what's happening is that you have this opening balance, right? The one I've just circled there. You add it to your interest, which is in the next column, and then you subtract the payment. That's the procedure. And that's, you're done. You even got the next year. You start. The closing balance there opens up the next year. That's the procedure. You charge interest. Always just remember that you're always charging interest on every new balance that comes in, just like the way you treat amortization scheme. Just what sort of happens here. Okay, you put your interest again. Remember, payment is fixed. It will be fixed throughout the lifetime of the lease. To be fixed. So you equally keep on subtracting payments, and you get a new balance there. That's your format most of the time. So usually they might ask you some side questions, so it's better to get it from this format. What is the non-current liability at the end of year one? How would you answer that? Well, what we just remember still on this particular question is that what is a non-current liability? Well, a non-current liability is basically a liability payable after 12 months or more than 12 months. So if you look at the first line, this is year one, right? Year one means what? That's just particularly within 12 months period, if anything. Do you think the end of the balance there would be categorized as non-current? No. If anything, by theory, what they even state is that that first balance there is basically the total liability there at the start, if anything, which includes non-current and current. But if we get back to our definition, non-current liability is something payable after what? After 12 months. So if you go to year two is obviously after 12 months, right? So the closing balance usually is the one which guides us to know whether we're going to pick the non-current liability, okay, for the particular period being asked. So non-current liability at the end of year one is the one I've just circled in the balance carried down column, this one I've pointed with an arrow, that's the non-current liability at the end of year one, because it actually even satisfies that definition. More than 12 months. That's why it cannot be the balance in the first line, the first year there. No, it's just that's maybe an easier way you can even remember that. It's basically just the one that comes in year two. That's the non-current liability in the end of what? Year one. Non-current liability in the end of year two, it will be the next one. This one I've put here just in the line for year three. So that's just how you understand this. So that's when payments are what? In arrears. That's how we remember. Payment in arrears, so we get the non-current liability at the end of year one and year two. How do we get the current? Current liability is just the difference between those two balances. That's one shortcut you can take. This balance here in year two, closing balance in year two, and the closing balance in year one. That's just the easier way you can get it. Closing balance in year two, just follow this arrow that I've bended like, and the closing balance in year one. That's it. That's your current. So you might be asked for finance costs. Finance costs is basically that interest that you're putting in that column for interest. That one is just direct. When they ask for finance cost in year one, just pick the interest in the line for year one. That's all. That one is direct. So those are just a few things you need to play around to understand your leases very well. Let us look at the if you're asked payments are done what? Or paid in advance. What happens is that when we are beginning such a scenario of payments being done in advance, right? What we do is that we can take this first approach. Let me just use this first approach. So there's actually, you can use this formula, the format, sorry. Here, the same. We'll start with a balance, quite right, an opening balance. Here we can put payment, subtotal. You have your interest. This is just like a format when payments are in advance. It's an easier format actually. You get to appreciate it more. And the closing balance. So yeah, okay, as we said, let's just use the same example, 3 years. So you have an opening balance, right? There you put a payment. We just said the payment is it will be given, it's fixed throughout the lifetime of a lease. It's fixed. You do that and it's always subtracted. So you have that payment as earlier stated, which you just get to, subtract from the opening balance as of the approach when they say payments are in advance, and then you put a subtotal balance there, which is just a subtraction of payment, the opening balance and the payment. Yeah, this is the approach that's taken, is that when payments are in advance, before you charge interest, it's assumed that take out that advanced payment first, so that when you're coming to charge the interest, you want to get the interest that will be payable as of the end of the year. So you cannot include in the balance that will have the original balance without getting first of all the subtraction of this advance payment, because to like give a wrong interest total. That's the reason why we get the subtraction first. So you subtract, then now you can get to charge interest, the interest that will be stated, and then you have your closing balance there, which is just an addition of subtotal plus interest. That's all. Year two, you start same procedure. The closing balance starts year two. Mind you, as long as payments were in advance, you're just subtracting first, and then you get to your subtotal there. Subtotal, you charge interest. Interest is always charged on the new subtotal as well in this approach. Then you add on interest. So you might be asked a question: what is the non-current liability at the end of year one using payments in advance? Which one do you pick? Same theory. Non-current liability cannot be within a year. It will just start from where? Year two. At least the year two is like after 12 months. Then which one do you get to pick in year two? Because there's a subtotal there, there's a balance. So what you get is that under this particular approach for payments in advance is that we get to pick the subtotal in year two. Please take note of that as a non-current liability at the end of year one. Yeah, because we do not include that interest because it's like pertaining to year two. That's the theory that's there. So you just get it from there, if anything. Current liability, almost similar in the same fashion. It's just, you know, I can actually get to subtract your subtotal here from year 2 and your subtotal previously there. If anything, then you get, in fact, this subtotal here and that. Okay. So yeah, like I was saying, current liability, maybe at the end of that same year, it's just the subtotal. You can subtract the subtotal in year 2 and minus the balance, closing balance in year 1. They'll give you the current. So these are basically the approaches that you take as you're sorting out a question or solving a question under leases. Depreciation is assumed to be on a straight line basis. By the way, if you asked for a lease, it's on straight line basis, where it's just the costs over a number of years. That's all, fixed throughout. Okay, so we've stated all the things you need. Let us actually answer a question. So we have a question there. Okay, Maxwell PLC has decided to acquire a motor vehicle for its director through a leasing contract with Stanley Bank PLC. The fair value of the vehicle is $750,000 and the lease term is 4 years. The contract requires 4 equal payments of $306,338.54 ngwe. At the end of each year, the motor vehicle is depreciated over 4 years on a straight line basis. The interest rate implicit on the lease is 23%. So all those details are given. Then our focus mainly is part 2 of the question, because the first part is just giving you, like, you know, you get to explain a lease, but our focus is on how the accounting treatment account for the above lease contract. That's part 2 of the question. That's show extracts in the lease statement of financial position and statement of profit or loss for the first 2 years as outlined in the IFRS 16 leases. So we want to follow that standard and account for this particular lease, the 4-year lease. So you've been given the payments, right? Equal payments of 306, if you can see it there. What's the fair value? 750,000. So what we get to do is that, first of all, we get to find the present value of those lease payments. That's the first step. Then after that, we get to, you know, compare the two, the law of the two. If they're equal, we just go with the same equal balance and choose the same one, and we start. That's what we do. So let's just do that. First of all, we just discount these payments and then get to see if they're all equal or one of them is lower. So I've brought these particular payments to the present. These are the payments. This is like the first step you should always do when you're solving a question. It's 5-4 actually. And then I just used a certain interest factor. I went direct to the interest factor for present value of an annuity. The rate is 23. The years are 4 years. I was getting 749.749999, you know, 0.99, something like that. They say that when you have a balance like this, and you know, you're getting to compare it with your fair value, right, to see the law of the two. If you have this kind of scenario, just go with the fair value because they are almost the same. There's nothing that will be saying, okay, it's just lower by a point what. No, usually we just get the fair value if it's in a scenario that where they're almost the same. You can just go with the fair value. So we'll take the fair value as our opening balance. So we always start with that particular fair value or the lower of the two if it happened in a scenario. And that's how we start our amortization schedule. Something to take notes: payments at the end of the year. So we'll use our first table. If you wind in the video, the one we started with, when payments are like in arrears, that's basically at the end of a year. That's how I had explained it earlier. So you would create your table, and I want to actually just share a screen of how you do that. I just want to just demonstrate that, okay, you would have that same table of year. Okay, you have your year, you have your balance. I said balance, you would say brought down. You would have your interests. After interest is always added, please. On that one, just take note. Payment is the same 306. It's fixed. And of course your balance carried down, the closing one, if anything. Okay, and then that's it. You move on to the next year until 4 4 years of this lease. That's all. They want you to, to play this for 4 years, and then you come and start making extracts, and I'll explain, which they just need for 2 years. So it depends. You can just end on 2 years because that's the info that you need. But I'll just take an approach of, let's just finish the question for the sake of understanding the amortization schedule. So let me share a screen of a prepared table of this amortization. Okay, so this is the schedule I was talking about, a prepared one already, as you can see. Take note, the payments were fixed as I have been stating, that it's a fixed payment throughout the lease entire life. So you've done your amortization schedule. As I earlier stated, that interest column, which is written by I, is just that rate, the 23%, which you always charge on the balance that is of that year. Okay, so like the first opening balance we said, which was the fair value, because it was actually just equal or almost equal to those present value of those payments that we make. Yeah, and I got that 172,500. Of course, added interest, subtracted payment, and got a closing balance. As I said, the closing balance will open the next year, and interest is always charged on the balance on that year. Just take note of that. So like in year 2, we charged on 616,161. That's what we're charging on the second year, but the rate is fixed. 23% on each year. We'll be using the same rate until 4 years. And most of the time, what you take note is that as of the last year of the lease, usually the closing balance is 0. That's just usually the fact there when you're doing your lease calculations. Then they said something, we need to make some extracts of our financial statements, okay, financial position and profit or loss statement for 2 years. Like we have to record some records that will be from this lease for 2 years. Okay, they said depreciation as well has been stated on a straight line basis, so we'll have to show all that. So what goes in an income statement? Depreciation, okay, and what else? Finance costs. We're looking at the as of IAS 1, that's standard. What goes in an income statement? Finance costs and depreciation, because when you look at a lease, it's categorized as a finance cost. Any interest on a lease is finance cost, so we need to show that. Any depreciation on a lease, it's equally put in the income statement, okay, as well, which will have to equally be shown as well. What depreciation will we be recording? So let me just show you for the first 2 years. So look at this, I've shown you there, right? That's the income statement. Take note that I'm using the finance costs, that's interest, as I said, interest paid on a lease, right? 172,500 for year 1. Why? Well, as I said, when it comes to interest, that same interest that is charged in that particular year is what is recorded for year 1, if anything. That's your year 1 interest. So any interest paid or charged on particular lease, that's your finance cost in year 1. Meaning the next year, year 2, the rate that you get to charge, which is 141,717, as you can see in year 2, that is what you will record as year 2 finance cost, because interest is finance cost from what we still record according to IAS 1. How about depreciation? Well, depreciation is on a straight line basis. We just said that. How do you get depreciation? We were just saying cost over a number of years. Now, what cost do you use? Mind you, we said a lease is actually capitalized as a non-current asset earlier on in our video, right? So what do you get as your non-current asset? Well, it's actually the fair value of this asset, or in a scenario where there's a lower of the two, you'd get of course the lower of the two, but most of the time it's our fair value, which in this case is 750. That would be like our cost of the asset. And depreciation is always dealt with on cost. Yeah, it's treated on the cost of the asset, so it's going to be 750, okay, divided by how many years? 4. What answer do we get? We will get that 187 you're seeing there below under the line of depreciation. That's the charge I got. And since it's straight line method, it's fixed. That's why even in year 2 you're seeing the same figure. So there's a 1 and a 2 there on top, representing year 1 and year 2. And that's how you would show the extracts for the first 2 years. So depreciation will be fixed and the like. How about in the financial position? What goes there? Well, we said, of course, we have to show this as a non-current asset. So that would be like our first recording there, non-current assets, as you can see there. Okay. So why haven't we started with 750? Since we said that would be like the cost. What do we record in the financial position? Well, when we're coming to record, of course, an asset's value in the financial position, we always state the cost minus what? Depreciation, and then we put the carrying amount. It's always a fact. We always take an asset at its book value when you're recording it in the financial position, which is the cost less any depreciation. So it was 750, right? Minus what? The depreciation, which is there, 187,500, giving you what? 562. That's how you get the figure there. So always, when you're recording the financial position, even though it's as of year one, always first of all subtract the dip, and then you get to put your figure. That will be your recognition in the first year. Second year, mind you, the asset cannot remain at the same place as years are going. It will keep depreciating. So you further subtract a 187, 500, which leaves you on 375, 500 as of year two in terms of non-current assets from your lease. It's just for 2 years you end there. You equally record non-current. This is the part which usually makes the lease treatment tricky. How do you identify the non-current liability? That's the NCL. I picked the four, as you can see, I've picked 451, 540, right? Why? Remember how we were finding those non-current liabilities from the start of the video. When you're being asked for non-current liability as of year one, why do you pick the second one, the one which is in year two, the closing balance in year two? We define that a non-current liability is something due after 12 months, right? So it cannot be the balance, the closing balance in year one. No, it's actually the balance that comes in what? In year two. That would be the non-current liability as of what? Year one. The assumption that is taken in the lease treatment is that the closing balance in year one contains both non and current. That's why it's never picked. Okay? The second year, which even actually makes more sense because non-current liability is after 12 months, and that's why we're going for the closing balance there at the end of year two, which becomes our non-current liability as of year one, 4,515. Okay, 451, sorry, 540. That's the first one you record as I've done there. How about year two? Because we're supposed to demonstrate for 2 years. If that was your year one there, meaning year two non-current liability will be the one under the line 3, the line here, year 3 there. That closing balance, we always pick the closing balances if it's usually in arrears, which is basically at the end of the year. So closing balance in year 3, 249, 055, right? That will be your non-current liability at the end of year 2. So it's just like a procedure, you even follow it. If they ask for year 3, it will be the one in year 4. If it was in year, they asked for year 4, it will be the one in year 5. You can even actually get that sequence if you're finding it difficult to get that actual definition of why we do that. So how do you get current? We said current liability, the best way you can actually just understand current liability is the difference between the closing balance in year 1 minus closing balance in year 2. That's how you get current. It's the easiest way. That's how you get the first current liability in year 1. Closing balance in year 1 minus closing balance in year 2, you get your difference. What about current liability for year 2? Closing balance in year 2 minus closing balance in year 3. The difference gives you the current liabilities, as you can see below there, as a CL. And that's how you demonstrate. So just remember all these tips. I would advise you rewatch this video and get to understand this standard of International Financial Reporting Standard 16, which is on leases.